Welcome back to another episode of Fun Friday with a special guest here, founder of President's Club Investing, Justin Moy. How are you today?
Greg, I'm doing good, man. I know we were chatting it up about some big moves. You're moving all over the valley, kind of my old place in Arizona, and
Yeah,
we shipped out here to the Midwest. So it's cool to hear where everybody's up to. Big moves in 2024 and 25.
most definitely. Well, you're also a University of Arizona guy as well.
Yeah. Oh yeah.
So we'd love for you just to kind of give your kind of high level overview to introduce yourself to the audience and really how you got into the chair you're in today.
Yeah, man. Was very fortunate growing up. First, I had an entrepreneur for a father, and he'd owned a restaurant for a very, very long time. He just sold it this past year, actually. Almost 40 years he owned it.
Wow.
And so
Not easy to
he
stay in business for a year, let alone 40.
Yeah, yeah. And restaurants, I mean, I think are some of the highest failure rates past year five or something. And so, growing up, I got to see that aspect of his life, which is kind of that entrepreneur's life. And then I got to see my mother's life, who she was the total opposite. She is very, very risk averse. She craves security. She doesn't invest in anything. She just likes the same old stuff. And honestly, I saw the quality of life that they both lived, especially when my parents split up. And so I figured, I don't want to be a corporate drone. I don't want to be, that middle class kind of office worker making 70 grand a year and doing that thing. I'd rather kind of swing for something a little bit more. And ultimately, I was very good at sales. I always was. I don't know why. Whether it was like selling candy for middle school boosters or like whatever, I was always like the best person. And so I thought that my road to entrepreneurship was going to be through selling real estate. Sold real estate, got my license when I was 18 years old, so didn't go to college right away. Sold that, loved it, made good money. This was in the Bay Area in California. So, 18, 19-year-old kids selling a couple $1 million properties. It was like the ultimate dream.
Particularly when money was longer then, and also when you're young
Yeah,
like that, I'm sure you're living at home where your dollar really goes further,
right.
right?
Yeah, I was crushing it.
Any
I mean, it
money
was
was
like
a ton of money back at that age. Yeah.
yeah, yeah.
Yeah.
It was, and it would be good money now, but back then it was like, oh my god, it was double what it's worth now.
Yeah.
And so I liked it, but I didn't want to work forever. And at this point, I would have been having to work for 40 years to hit that 65 or 70, whatever they call the golden years now. And so, I looked into how can I get out of this rat race. Alternative investments made a lot of sense naturally because of my experience. Real estate made a lot of sense. And so I kind of hit the go button on, some people call it the FIRE movement. I call it work optionality. That was my ultimate goal for a long time. So that's kind of the 10,000-foot view of my experience. Then after I went to college, a couple, did life a little bit backwards. But that's really what I would say were like my defining moments that kind of created my life.
Yeah, it makes a lot of sense. And I think what you've mentioned there really resonates on a couple things. So number one is kind of not having a more traditional lifestyle and kind of taking the kind of safe
Mhm.
conventional route, which could honestly be the most risky thing you do, is because, if you don't get the
Yeah.
upside that you want to live, or you're kind of living a life of quiet desperation where you're really not happy, you're really not
Yeah.
alive in your day to day, that's not really a way to live. I think you're kind of dying
Mhm.
slowly by doing that, as opposed to, living, I would take less years of my life, but having a very rich experience during those years, as opposed to
Yeah.
kind of the boring conventional route of things that, that doesn't have that much of excitement or kind of thrill or
Yeah.
zest.
Yeah. And I would say, people, I've, and ever since I've started posting my journey on social media or Instagram, whatever it's going to be, you of course get a lot of hate and a lot of people kind of talking shit about what you're doing. And what I always tell people, they'll say, well, that sounds really risky. Like, why don't you just put money in the S&P and be happy? And why would I risk all my money in something like real estate? It's like, dude, like your best case scenario is my worst case scenario. If this didn't work out, okay, I go back to being a corporate drone. I go back to investing in the S&P 500 and I work until I'm 70. That's your best case scenario right now.
Yeah.
So I'm okay with that trade off.
Yeah, I'm okay with that. I'm okay with having larger upside. And also,
Mm-hmm.
if you, really hit it, then great. And if you don't do exactly what you'd want to do, well, you probably learned a lot of skills actually along the way, risk taking,
Yeah.
stuff like that, that will only propel you more in the future. And
Mm-hmm.
also just makes you more interesting as well, generally as a person, which is super cool.
Yeah.
So it makes a lot of sense there. And then selling, real estate, it's kind of cool and interesting as well, because I was selling real estate before, and
Yeah.
probably just like you look around and you realize you can make a really great living. but you're pretty geographically tied. I know you like to
Yeah.
travel, you like to see the world, you like to do things more than just kind of the conventional route of things, which is
Mhm.
great. And there's nothing wrong with either or. It's just kind of the way you kind of want to design your life.
Yeah.
But similarly, with selling real estate, and then you kind of learn about other opportunities. You meet certain people, and maybe you go to a club, you listen to a podcast, and you realize that the world's actually really big,
Yeah.
and there's a lot of options out there. So similarly, I had that experience with selling homes, and it would have been fine. But it's all about just getting in the vehicle, getting in the car,
Mhm.
metaphorically speaking, to get to the point where you've got enough kind of cash flow coming in where you're happy with your lifestyle. And that
Yeah.
was a big thing that on my end, I kind of had my aha moment where I was selling, I was doing well here in Phoenix. But then it's like, well, what is my long term goal here? And how do I get to
Mhm.
that point where I'm financially more free? And it was kind of the alternative route, and
Yeah.
I found that. And I obviously got to meet with really great people. You get to meet some people along your way that really kind of change kind of the course of your life. I kind of
Mhm.
found that with obviously Rob. So I feel very grateful. Did you kind of have a similar path to that where you're looking around like, hey, this kind of makes sense as an aha moment of sorts, or, what
Yeah.
kind of really sparked the transition into kind of the alternative world of things?
Yeah, I would say I had that big the walls were closing in moment of the geographical kind of tie because I was
Yeah.
selling in my home neighborhood, and I thought, if this business really takes off, am I going to want to leave and
You're
have to
handcuffed.
start all over? And yeah, you have to stay right there. And it was really weird, man. I'll tell you the story. I got up one day randomly, and for whatever reason, like that thought just hit me, and it was like I don't really get like panic attacks, or I don't want to say I had a panic attack, but I just had this feeling of like, oh my god, like I'm making a life commitment right now to like never leaving my hometown. Like, is that what I want to do? And I think like the next day or the next week or something like that, I was home sick or doing something, and I was watching TV in the middle of the day, and it was like an Oregon State football game, and the camera pans to the student section. I just thought, dude, like that looks so fun. Like maybe I should do something else in my life. So yeah, I had these really weird moments that stuck out that for some reason I just felt I'm handcuffing myself right here, and maybe this isn't what I want to do long term. So what's that next thing? Now, naturally, when you feel that way, you start to look for different alternatives and see things that have always been there, but you never really paid attention to. And the thing that I picked up on was, a lot of my clients were investors. It was totally by accident. I didn't mean to niche off into that, but they were investors in the single family space. And I remember sitting thinking to myself, I'm selling this guy's house. It was like two or three clients I had. Like, I'm selling their houses, and we're getting offers. And I'm like calling them, I'm texting them. I'm like, hey, like we have these offers. Can we respond? And they responded to me like a week and a half later, like, sorry, man, I'm on a boat. Sorry, I'm out of the country. Or sorry, I didn't
Totally
have to see.
nonchalant.
Yeah,
Yeah.
didn't care at all. And to
Yeah.
me, again, I'm 19, 20 years old, maybe 20 at this point or
And that's the
21.
center of your world, but their world is
Yeah, they don't
everywhere
even
else.
care.
Yeah. Yeah.
Yeah, and again, I'm young, so to me, it's like, dude, like I'm about to get you net you $500,000-$600,000 in 30 days from now. Like, just sign this offer. Didn't even care. And so I think that was, I started to pick up on that trait of a lot of my investor clients of like, this is not a big deal to them. A couple $100,000 was not a big deal to them. They were on a boat or they were partying. I was super stressed out. I was working all the time, and they like didn't really care. Um, I'm sure they cared, right? But they just were kind of nonchalant about it at the point. So that's when I thought, okay, like that's the more of the lifestyle I want. I want to be the guy ignoring my broker's calls because I'm on a boat or I'm doing something else that I want to do. It's not really a big deal to me. And
Yeah.
that's kind of the linchpin that I said, okay, that might be more the lifestyle I want. Let me see how they did it and kind of pursue that path.
Yeah, and I think the biggest thing to think about is there's not one right direction, and life's not linear.
Yeah.
So I totally see your perspective there, and kind of an interesting thing, just anecdotally as well, kind of pertaining to your story, kind of drawing it back to mine here, was when I was selling property in the Bay Area prior to me leaving to Phoenix. I was starting to do really well, but I was wildly empty inside. Something
Yeah.
just felt wrong, and I'm someone
Sure.
that I'm all in or all out. I don't really do stuff with kind of a foot in. I just
Mhm.
can't do it and I can't fake it. And maybe I feel things to a certain extent too much.
Yeah.
But I kind of made the decision like, I don't want to live here long term. And that feeling when you're residential real estate where that is a long term
Yeah.
old person business in a sense.
Yeah.
Those who stay in the business longest, it's a war of attrition. The longer
Mhm.
you stay, the better you're going to do. But also, guess what? The more deep tied down you are to that area. And
Yeah.
I kind of made the decision like, hey, I don't know what's going to go on. I can always move back here, but I can't leave. Or the longer I stay in this, the harder it's going to be for
Yeah.
me to leave. And 5 years later, I'm very grateful for that feeling to act
Yeah.
on it, because not everyone does. A lot of people do, in fact, die in their hometown. They never leave. And there's
Hmm.
nothing wrong with it. It just wasn't going to be the life for me. I had kind of a
Yeah.
thirst for something else, but kind of having that feeling, I'm like kind of having that reaction again, like, oh yeah, this doesn't sit right in my soul, in my heart,
Yeah.
where I know I can't be here long term.
Yeah. And I think that is important because it shaped the way that I see everything in the future. Is I know I like to move around. I like to bounce around. I spent most of 2024 being a digital nomad in Latin America. And so when it
So
comes
cool.
to my investing strategies or what I do, like that's one thing that's mandatory is that I have to be location agnostic. So I've always told myself, hey, I don't think I would ever open up a brick and mortar business or open like a restaurant or a printing shop or something where I have to be there because
You don't want an anchor to your
yeah,
life. Yeah.
exactly. And even if I love the place, I've in other jobs have worked with business owners of brick and mortar businesses, and they've even said like, man, like this thing is just tying me here. I want to go somewhere else, but the business can't survive. I have to be here. And so I've seen other investing opportunities that may be great opportunities, but they kind of anchor me to a spot. And so understanding that with my criteria as well has really shaped a lot of what I do now in kind of the fund management space and the syndication space. Because there's a lot of other verticals you can invest in, and if you want to be location agnostic, you should pick different verticals maybe that are more aligned with what you want out of life.
And I think the really cool thing is we live in a world now where you can find the resources in a career path if you want to make certain sacrifices that maybe
Yeah,
today don't pay you as much, but if you put the right systems in place, or if you sacrifice a chunk of your life, you can kind of get that autonomy and geographical freedom that you want at some point.
yeah,
And to that kind of, note, I live in Phoenix right now. We're obviously chatting about it. You, of course, lived here at one point.
yeah,
You just saying you're traveling through. For me, I don't want to stay here in Phoenix year round. And that's kind of the moment I had when I was selling real
yeah,
estate here again is, oh, wait, I'm going to sell property here in Phoenix in July and August. That sounds terrible. I don't want to do that. I don't want to be living for, my couple week vacation a year, as
yeah,
opposed to doing what I do now. I have designed my lifestyle where if I have a Wi-Fi connection, I have a good,
hmm,
speaking audio setup, I can be anywhere, work from anywhere, and do my thing
yeah,
similar to yourself there. And I think that's worth so much more. And I think one thing to think about is you get paid in multiple forms of currency.
hmm,
And I think a biggest kind of one of the biggest forms of currency that I frankly prioritize is geographical autonomy and freedom.
yeah,
And I can achieve that now, which is super special through
hmm,
this route, which is obviously something that I've been really looking forward to doing and excited to do, and only keep doing more in the future, but also designing my life from an investment perspective, from a structuring perspective of, my house payments, my mortgages, to basically to the point where I can be where I want to be, what I want to be, and I gotta kind of be anchored down too much through passive investments and things of that
yeah,
nature. So super crucial to kind of set that up. And
hmm.
as you kind of do go through your life moving forward, when you do make your choices, how much of your thought process is kind of based around, is this tying me down, medium term, long term, short term with regard to, investing and kind of how you design and set everything up?
Yeah. So, everything starts, in my opinion, at what's the life that you want to live. I think one of the things that sucks about the traditional way that at least education is in America is you kind of pick your career and then you kind of structure your life around your career, as opposed to maybe the other way around. I should structure my life the way I want, and then the career or whatever, however I make my money, needs to kind of fit into that. And, so that's always what I think about. Returns are secondary, return on my money versus things like return on headache or location agnostic abilities, risk tolerance, things that will help me sleep easy at night. So it's always like, does this investment fit into the life that I'm creating, that it could give me more security now, or kind of bridge me to the life that I want, in 10 years or so. In terms of timelines, I do believe like there's these phases of your investing journey that you need to acknowledge, especially when you get into real estate investing. The way that I see a lot of people misunderstand this asset is they look at a piece of property, maybe from Lone Star, and they go, man, 4% cash return. Well, if I invest 100 grand, I get 4 grand this year. What's the point? Like, you're right. What's the point? Like, that's a horrible return if that's all you're looking for. But at the end of the day, you need to find out ways to multiply that money into something meaningful. I'll give you an example. For me, I love debt funds right now as kind of a high cash flow asset. I have investors in my funds and even me personally who live off of our passive income. Now, if I have $100,000 to invest and a debt fund will pay me 10%, I'll make 10 grand a year. That's okay, but I'm not walking away from any jobs that I hate on 10 grand a year. So if I have 100 grand to invest, I need to multiply that thing. Like, I can't just sit on that. I need to go into value add or in some other kind of asset that's going to make that into 200, then into 400, then into 800. Now, if you walk up to a debt fund with $1 million, it's paying you 10%. Yeah,
It's
you're walking
meaningful.
away. Yeah. So, you have to have these phases where you're multiplying your equity and then you're kind of putting it into whatever's going to be your longer term vehicle. But usually my long term vehicle is going to be cash flow. That's not what I invested in really all the way up until this point. I was multiplying my money. I didn't have the $1 million to place, but I knew once I had that $1 million to place, okay, I could put that into this fund or whatever your vehicle is going to be. And now that's some real meaningful money. So, I see things in what does this fit ultimately in my long-term vision? What do I need? If I need 3 or 4 or 5 million dollars in a vehicle that will pay me 8 or 9% or 10% return, that's great, but I need to get that 4 or 5 million bucks. How am I going to do that? Well, I probably need to invest in kind of shorter term plays that are going to help me get there faster. So that's how I see investing is like, what's the phase in your life for you as an investor? And what do you need to invest in to get you to your ultimate goal fastest? Because you can invest in debt funds or cash flowing assets your whole time and just keep putting money there. But chances are there's other assets that'll help multiply that a little bit quicker. And you can hit your ultimate, passive income goal a lot sooner if you do things in the right order.
Yeah, no, I really like that. And also, it's kind of funny you mentioned chapters and stuff. And I like to think about seasons as well, where you're at and where the market's at, right? Like, for instance, right now,
Mm-hmm.
nothing really makes sense right now. If you're going to invest in
Yeah.
multifamily, guess what? Cash flow is probably going to be a touch lower depending on the market that you're in because the debt market right now is terrible. If you're to identify a property today, and by
Yeah.
today it's January 22nd, 2025, if you're wondering for historical purposes, the market's really choppy right now.
Yeah.
But guess what? When interest rates are really high, guess what also is really high? Your debt investment income, right? So
Yeah.
there's just different chapters and seasons. And then eventually at some point, probably the second half of this year, that will change, that will fluctuate. So
Mm-hmm.
the market will give you a certain set of circumstances, and it's up to people like Justin and myself and Lone Star to kind of help you point you in the right direction to, really how do you best allocate your capital with where the market's at. And I think it's super important
Yeah.
to identify and recognize where that is, because I think so many times people get trained to want to do one thing. They want to have one approach, want to do value add investing. It's like, well,
Mm-hmm.
I think, there's times for that, but there's times where that's actually maybe not the best idea depending on where we're
Yeah.
at. So just kind of having an open-minded perspective and working with professionals like Justin will kind of help you get to your goals
Mm-hmm.
as quickly as possible, naturally with what the market's giving you. That
Yeah.
said, what was your first real estate investment?
Yeah, my first real estate investment was a 40 unit deal that I did. And I did it with a couple of partners. It was in, not a great area, man. I'll be honest. It was not an ideal deal. It's not a deal that I would do again. It was
Sometimes you
fine
need
for,
those. Yeah.
yeah, it was fine for a first deal, but it was a real class C. It was like that real class C, heavy, heavy, heavy value add. And it had a lot of risk to it. It had a lot of risk that I didn't really recognize at the time because I was in that investing phase where it's like everything is rosy. Oh my God, all the cells in my sheet are turning green. Like
Yeah.
it's time to buy this thing. It was an invaluable learning experience. Like I said, it's not something I would do again. It really pushed me kind of out of the class C market, which maybe that was just a bad thing. Maybe I should stick around, but it kind of made me realize if I'm going to play in these games as class C, the heavy value add, the gut rehabs, all those types of things, like there is just stuff that will happen during the transaction that you just will never think of. We had a tenant who called in a work order, and no, she didn't call in a work order. I think they stopped paying. For some reason, we had to go in there, and I opened the door. It was, to this day, it's the worst smell I've ever smelled in my whole life. And I immediately thought, oh my God, like she died here, maybe.
Yeah. There's something
And
rotting and dying at least.
there's
Yeah.
something, a horrible smell. And it's not like this smells bad. It's like it physically like pushed us back. Like, oh my God, something really is wrong
Probably
here.
felt it in your eyes even and probably
Yeah.
stayed in your clothes.
Oh,
Yeah.
horrible. It's
Yeah.
like, it was like a physical barrier. And we thought, okay, well, somebody probably died here. Let's go and check it out. She didn't die there, but I guess weeks ago, months ago, or whatever, her toilet clogged. Never called it in, never said anything, and never stopped using the toilet.
Oh my God.
So we walked into the bathroom, and the only reason she had stopped using the toilet is because you physically could not sit down on it anymore.
Oh.
And so I think I walked out. I'm just like, what is it? What am I doing? Like Brandon
Yeah.
Turner never told me this. Like I
Yeah.
have to do this type
Yeah.
of thing, you know? And so you just have these like experiences in your investing journey that just shape, you know, okay, I'm going to minimize my exposure to stuff like this. And I'm going to go do other stuff. So, you know, to speak to your point of like different seasons of investing, yeah, there's going to be some very hard charging day one investor who's going to take on like the ugly, horrible project in the C-D area, and they're going to save the world by, you know, renovating these properties. Yeah, that's not my season anymore, man. I'll stick in the class B or class A. I'll take a couple points off my IRR and I'll be happier with that.
Yeah. Well, it's kind of funny because we've got a couple of C properties, but we've got one property that was more of a legacy asset, something that's in our
Mm-hmm.
portfolio. It's been there for some time, and the
Yeah.
property's done pretty well. We've actually refied more than 50% of capital back to investors.
Nice.
But funny enough, when you have properties like that, you've also got tenants that might be a little bit special or particular,
Yeah.
and that property still to this day has got a lot of problems. And one problem that it's had, and it happened multiple times, is there have been several tenants that have driven into the property, which is crazy. So, and it's like, I
Yeah.
don't know, are you drunk? Are you on drugs? Probably both.
Yeah.
Maybe neither. Hopefully, God
Yeah.
forbid, people are, being irresponsible and reckless like that. But it's nuts. And it's really
Yeah.
nuts because, it's happened multiple times on this property. But to your point,
Mhm.
that's kind of what you can get with Class C. And until you kind of live that and cut your teeth a bit on a touch, your
Yeah.
philosophy maybe not change as much, but that probably, physically moved you from a smell perspective, but from a mental perspective, it scars something to your brain. And, maybe you needed that because that was a season that you're in and that's where you needed to go kind of to get to
Yeah.
the next spot.
Yeah. And I think too, it kind of shelters, like from what I do from a fund manager perspective is, you know, placing capital into great operators like you and Lone Star, for example. It gives you just a little bit of a buffer of how can I see deals beyond paper? You know, another experience we had in another property is, again, Class C property. And there was a homeless encampment a couple, maybe a block or so down the road from it, but it wasn't ever really an issue until suddenly the city had shut down that encampment. And then what happened is those hundreds of people, they go look for the next spot. And one day in the middle of the night, I remember I woke up and I probably had 60 or 70 calls on my phone.
Not a good feeling.
Yeah, I was like, oh my God. And they had just torn through the property. I mean, like all, you know, 50, 60 people that were living in that shelter, somebody found a loose door or somebody found an unlocked door and they just camped in. And like, you know, just these crazy things that you never can underwrite. But now it's part of my due diligence process, man. I call the police station every place we invest and I just say, hey, how's the property? What's the reputation? Where's the nearest homeless encampment? And I just grill them and I just ask them, like, I'm going to move in. Like, what are your thoughts? You know, I get those answers now. And it's just something that you would never think of just being a passive investor or maybe just following people on social
Or
media.
looking at it, yeah, or looking at a marketing brochure, right?
Yeah.
There's a story within the story there.
Yeah. Yeah. Never. And so, you know, just having those experiences help shape you as an investor and help you realize, you know, deals could have risk that you will never see. And nobody's expecting that. You're not a bad operator if you don't put where the nearest homeless encampment. Like nobody thinks of these things.
Yeah.
But just you got to do it. You got to place the money. You have to wake up to the 70 calls at night and you have to talk to the police about what to do with this. You know, you just have to deal with those things before things really stick and the lesson hits you and you can go invest in better assets after that.
Yeah, without a doubt. And, unfortunately, your return profile and risk premium is definitely going to vary based upon that, but for good reason. And it makes
Yeah.
sense. But it's interesting there. And I think a lot of times, and I'm so happy you mentioned this point, which I think a lot of people look around at, properties, investing, and they think everything's kind of a widget, right? Like
Mhm.
you're just, it's a machine, it's a factory, it's printing stuff out. But these are human businesses. And so often we forget, hey, these are human businesses. This is 150 to 400, units, which
Mhm.
means there's 150 to 400 potential families living on this property that
Yeah.
live here that, hey, they have to interface with other tenants. They have to interface with
Mhm.
managers. They've got to interface with a lot of stuff. There's turnover. There's a lot of moving parts going on. And this is a human business. And then
Mhm.
you boil it down further, which, hey, then you've got property managers and kind of people of that nature that are watching it. And these are, employees that might get paid $100,000 a year, $80,000 a year that are managing, I don't know, a 20 to a $60 million property.
Yeah.
It's absolutely crazy, but these things are super important. And
Yeah.
management is such a thankless job, but it is the needle mover that really defines a good investment or a bad investment. I mean,
Yeah.
particularly when the deal starts going south, the management team all of a sudden be like, yeah, we're not really interested because guess what? We're not going to be here long term. Why
Yeah.
would we manage? We're just going to go apply for a job down the street because there's so much turnover there. And,
Hmm.
labor is just very difficult to solve for. And frankly, the employee there, the laborer, which is not a bad thing, but some cases it can be taken advantage of.
Yeah.
They've got more leverage, and your job is not as important as what they want to do at the end of the
Yeah.
day, and they can find
Sure.
another job. So it's so hard to solve for that really over the course of time, but it's so important to actually find
Mhm.
good people because this is a people business. This is a
Yeah.
$50 million people business, typically speaking.
Yeah. And that's a big thing too that I started to realize semi recently is I was always a very big stickler on like vertically integrated management systems. I thought that that was like the hands down the way to do it. If I'm going to invest in group A or group B, and group B has their own property management company, like group B got my business every time. But we've come to realize, at least in my experiences, just because there is vertically integrated property management doesn't mean they're going to recruit the best property manager for that asset. And oftentimes it can even be something that's harmful because we've had this situation where with third party management, if they have a big roster of managers to pull from and somebody's not working out or somebody quits, somebody calls in sick, they can just kind of cycle somebody in there. That may not always be the case with kind of vertically integrated management, or maybe you can't attract the top talent like the biggest property management company in the city can. So, it's a people business, like you said, and it's specifically the people right there. Most deals, the day to day is ran by between 1 and 4 people that are on site, right? And so it's who are those 1 to 4 people? How can I make them very happy, whether they're third party or vertically integrated, and make sure that our visions are aligned for how the property performs? How can I pay them well in an environment where margins are slim in multifamily business now? How can I incentivize them? It's a business of keeping those people happy because they make the biggest difference on the property. And not all companies that are vertically integrated know how to do that, like third
Yeah.
party companies can.
And then, one thing we've been really working on is basically, or there's several things, right? So we've become, from a mantra perspective, I don't know if you've heard this before, but we've become not an acquisition property that manages, but a property management company that also happens to do
Yeah.
acquisitions, property management, asset
Mhm.
management, of course, pretty
Yeah.
synonymous with one another, as opposed to the other way around. And it can't be
Yeah.
the other way around, because if it is the other way around, the focus and the investment dollars, people aren't going to re-up with you again if you don't do a good job and if you don't manage, because there's too many good
Yeah.
options out there. So what
Mhm.
we've really done trying to do a good job of is align interests. So basically, and good incentives on, basically, good, making sure there's no bad debt, making sure their occupancy numbers where it wants to be, making sure that, the on-site property managers and staffers and people like that are, guess what? They're doing the right thing. They're on site. They're
Mhm.
fixing stuff quickly and basically explaining them the importance of basically a lease renewal as opposed to turnover, stuff like
Yeah.
that. And then just explaining the nitty gritty to them, why it's important, and, how valuable they are, and really basically making them feel special is super crucial. So those
Mhm.
have been some of the things that we've been really working through as a team, that we've put the place of management, not really on the acquisition side of stuff as much,
Yeah.
but more on the property management. That's really essentially what Rob does with his day to day now, is
Mhm.
in fact that, with me kind of getting more schooled up, Brad getting more schooled up, and Dasha. So,
Yeah.
with our team internally getting better, it focuses, allows us to basically do the important stuff, which is managing. And, going back to seasons and chapters right now, with supply coming online, with the
Yeah.
market, kind of being a little bit more choppy, with the economy not being so good, management has never been more important. It
Mhm.
really has never been more important. And it's never been harder right now, particularly in these economic times.
Yeah. And I'd say on-site management has never been more important.
Yes.
You just have to be there. There's no way around it. There's no excuse. That's why I don't manage assets, like I mentioned
Yes.
before. I don't
Me
want to
either.
be
I
on
wouldn't want to
site.
do it. Yeah, that's not.
Yeah.
If I did property management, asset management, I would be selling homes still. That'd be my
Right.
preference.
Yeah. And so, that's one thing that's really important too, is in my like due diligence process, it's always, well, who is on site? I mean, it can't be nobody. And it can't be, oh, I'll fly out once a quarter if I want to. Like, no, like somebody has to be there. Just your presence, even, when we've managed properties ourselves, just me showing up for an hour a day or something, you see like drastically how different things are. And it's even in different questions. When I would show up to our properties and I'd sit there and work with the manager, she would ask me some interesting questions about, well, how can I respond to this objection for this tenant, or will we offer this for them? And they never send you those questions. So if you're not there, they're just not going to ask. They're just going to, say, no, we don't do that. Sorry. And kind of turn the tenant away. So being on site and being very hands-on, it's something that's non-negotiable right now for successful operators, and the people who bought with this whole passive income mindset of just give it to a manager and they'll do the best they can for you. Yeah, those are the people that are struggling the most.
Yeah. So let's transition into what you typically raise for. So Justin, when you're looking at opportunities, what are you getting excited about? Like, what type of deals are you doing right now, particularly in this point right
Yeah.
now? Like what are some of the deals that you would be interested in, and I guess products and asset types?
Yeah. So, I've been a multifamily guy for most of my investing career. But like you mentioned, hey, multifamily's been a little bit choppy the past couple of years. I haven't really loved what I've seen. This year, I love a couple of things. I really am getting interested in the RV park and mobile home park space.
Love that.
I think there's economics there that are really, really enticing, specifically from a pre-institutionalized perspective. And I really like industrial properties. I think the economics and data behind reshoring trends and China's labor and energy costs versus Mexico's labor and energy costs, or even America's labor and energy costs, potential tariffs, all of these things are macroeconomic factors that you cannot ignore if you want to be a successful investor. And so, I've been a multifamily guy. I love multifamily. I always look at all the multifamily deals that I see. I just haven't really seen ones that I've loved. I still think they're being overbought a little bit. But if you're going to ask me what the asset class that I'm most excited about probably this year, I'd say it's those three. And I think probably industrial wins that battle right now in terms of what I'm most excited to invest in and pull the trigger on next.
Right. Is it just because you've got onshoring, you've got
Yeah.
more, I guess, momentum towards needing space and whatnot? Like, what
Yeah.
specifically about it, and what locations are you looking in as well?
Yeah. So when it comes to industrial, yes, the reshoring, the onshoring, the difference between having product on hand versus product shipped, a lot of sentiment for that is changing. And ultimately, it's about cost. Right now, it's cheaper for 32% of American businesses to produce their goods in the States rather than in China. If Trump enacts tariffs, I think the tariff was 25%, he said, on China. That number turns to just under half. I think it's like 48% or something like that. So now you have all these businesses that it isn't just an ethical thing, or hey, you love to be made in America, or wow, would love to support small business here, something like that. It's an economic thing of it is actually cheaper for me to do it here. It's less risky because I control more of the product. And if you're not going to do it here, you're going to send it to Mexico or to Latin America because their energy costs and their labor costs are lower than China's right now. And China's only projected to get worse. So to me, whenever you can see trends in the future, you got to look at those, you got to acknowledge them and see how you can get in front of them. In terms of locations, I really like kind of south towards the border, just because of what I mentioned in kind of production shifting to Latin America. I think that's a very real data point that you have to look at, or by major logistical arteries, big freeways. There's a city here in Kansas called Wichita. That's a big kind of production hub. There's big arteries to all, you can get anywhere in the country from the freeways that are there. So you want to look at like who's using it, how it benefits, what kind of industries they serve, and what kind of the data are you getting ahead of. And I think it's impossible to ignore that more production is going to come back to the States. It's just impossible to see any other way.
Yeah, it's inevitable. Yeah, that makes a lot of sense. And I think
Mhm.
onshoring and reshoring is good. It's also a different kind of product type too. It's a little bit easier to manage four walls and a roof with very little
Yeah.
plumbing as opposed to the labor
Yeah.
intensive nature to multifamily, right?
Mhm.
So I
And,
think it's
and who
super good.
knows? Maybe it makes me a triple net guy if that's
Yeah.
the case, right? Because most of these are absolute triple nets, and if you see some of their P&Ls for these operations teams that are very good at what they do, there's not that much on the loss side, on the expense side, because it's just a triple net. Like they don't. There's no obligation to manage. There's no turnover. It's a very, very enticing asset class that I'm kind of wrapping my head around. But I think I'm pretty close to pulling the trigger on an opportunity. I'm just not 100% yet.
Yeah. So are you doing development in that space or existing kind of value add plays where a lease might
Yeah,
turn up?
I'm not a big development guy. I like a certain level of cash flow, even if it's not a significant portion of the returns from day one. But to me, it's like, if I invest today, I want to get paid tomorrow. And I feel like cash flow is a really good defensive metric for your returns in your projects. So I'm not a big development guy. I like the as is. Some of these deals, they're just bought right. The triple net lease space is a space where you can get some healthy yields right away. There's also sale leasebacks that are happening that are very enticing. There is value add potential with things like tenant improvements, or I'm okay to buy something if there's a development aspect of it, but that can't be where the returns are majority coming from, right? If you're going to develop or expand, that's kind of how you do value add in the triple net space. So I'm open to all those things, but really you see deals that are bought right, and that are good basis and seeing good yield really from day one with high credit tenants.
That makes sense. And then, what are kind of some of the other items that you get you nervous or maybe excited for a deal when you're looking at, I guess, mobile homes or multifamily?
Yeah. So, you look at what's gotten people in trouble over the past few years. And I love
Long
this
list of that
mindset.
right now, particularly, but yeah.
Yeah. Yeah. And you look at
Yeah.
what's gotten in trouble, and to me, you kind of invert that thing and you should avoid a lot of trouble. So, what got most people in trouble over the past few years? High leverage. I'd say anything over 70%, I'm a little hesitant on. 75, maybe. Above 75, I'm really not touching it. I like my debt to be in the 60s, mid to high 60s, ideally. So that got a lot of people in trouble. Uh, Low or no cash flow got a lot of people in trouble, especially things like development, which are ultra sensitive to interest rates. You saw a lot of those projects get shelved. And when you have low or no cash flow, time becomes your enemy. You're really racing for something, whether it's execute a value add or it's, I'm banking on 24% rent growth again in Phoenix, like I did the year before, whatever it's going to be, So people bought with low or no cash flow on an as is financials basis. I want to know what the as is financials are. What's the cap rate we're buying on a regular T12, or I'll even look at a T3 annualized. But people were buying based off of future income, not based off current income. And that in the commercial space is called overpaying for an asset, in my opinion. So people overpaid by not having cash flows. People took on too much loans, or they just didn't really understand the tenant profile that they were going after. They didn't realize that the Class C tenant in Phoenix was already spending 50% of their income on housing. Like, you cannot value add this thing. Like, there's just no way. You can't
Max
charge
out.
for parking. You can't value add. You can't push rents. You can't, at the end of the day, you can't just bleed your tenants dry and say, we're going to charge for parking and laundry and roofs. And then we're going to do a $5 trash valet. We're going to push rents through, all these things that you just stack on, the tenant kind of has that breaking point, and you shouldn't be looking to do that. So, you look at the things that got people in trouble recently, and man, you invert those and you stay the hell away from those. So I stay away from a lot of a highly leveraged product, and I stay away from deals that don't have good cash flows on as is financials or on a day one basis.
Yeah, and then let's talk about mobile home investing. What's kind of your thought there? Where you're looking, similar kind of sunshine state areas, and
Yeah.
kind of some of the metrics there that kind of get you excited as well.
Yeah, I'm excited anytime you have an answer for an affordability crisis or an affordability issue. I have another investment in the short-term rental space, which to me was kind of the affordable avenue relative to hotels, especially in larger spaces where it's much more economic for a large family to rent a big Airbnb versus get, 4 hotel rooms or whatever they have to do. So to me, if you have a product that is kind of the affordable option, you're going to do good in hard economic times, and you're still going to do good in thriving times, because there's always going to be that person who craves kind of a more value based option. And then keeping in mind too, a lot of these like mobile home parks or RV parks, you just own dirt. You're kind of leasing the lot, so there's not a lot of maintenance or other liabilities on you. So anytime you can see similar returns to a value add, but you can pull risk away from it by doing things like not taking on value add, not renovating, or just having land to lease out, those are going to be good asymmetric risk adjusted returns. So there's a couple aspects there that I like. I like the need that it solves, and I like the structure of the returns where you see a lot of pad rentals as opposed to owning a lot of structures in these things.
Makes a lot of sense. Now let's talk about vetting sponsors and how you find people you work with. Do you have a kind of a criteria, a certain kind of
Yeah.
checklist of sorts? I mean, how do you get comfortable with a sponsor?
Yeah. I really like to be in a sponsor's network for a fair amount of time, whether that's having their email lists, whether it's just following them on social media. Part of what I want to see is I want to see how they think. And there's a lot of things, right? Especially when you see a deal, I'm doing my best to avoid the things that you've probably heard a million times listening to podcasts, with track record and projections versus actuals, right? I mean, we all know those things, but ultimately, like you mentioned, it's a people business. I'm investing with people. I want to invest with people who stick around when times get tough, who are okay talking about when things are not going right or not going their way and how they're adjusting to it, who are always learning. One thing about President's Club investors is I started that company because in the sales world, the President's Club, and you probably had this when you sold homes, the President's Club is the top 1% of people. And to me, I take that mentality to everything I do in the company. I want to invest. Doesn't mean you have to be the top 1% financially, but you have to have that mindset. And what do the top 1% of sponsors have from a mindset perspective? They're always growing, they're always learning, they're deeply networked, they're very educated, and they're okay sharing that education, and they're adjusting all the time. So I want to see how that operator is adjusting at different times. I want to see how they're talking about their portfolios, their ups and their downs, and ultimately, honestly, judge their character. I
Yeah.
want to see if they're just a good person who I believe in, if I believe what they say. I actually keep track of things too. Like there's one big real estate personality. I won't say who it is, but within the span of like 2 or 3 months, drastically changed the way they were talking about a certain asset class. And I told myself, well, I bet you there's a deal coming up in that asset class when, a couple months ago, it was a dumb idea. It was horrible. Now all of a sudden it's the greatest thing ever. And then, a couple weeks later, here was this big raise they were doing. That doesn't make any sense to me.
Yeah.
So I'm kind of looking for things like that, inconsistencies, beyond the things that you've heard many times, right? That people are always looking for. But I like to be involved in their network in some way and see how they handle themselves.
Yeah, and I think one really big item, and we've gotten the pleasure of getting to know each other for since really 2023.
Hmm.
I think we connected in person for the first time in New Orleans.
Hmm.
But really judging and sizing up the landscape is super important, but also just going slow into relationships is very important. Either when I look at myself with working with Lone Star Capital, knew Rob for some time. It was very
Yeah.
cool. I knew what he was going to bring to the table. He knew what I was going to bring to the table. Perfect mutual fit. And we've been very, very lucky from that. And some of the best hires that we've had at Lone Star Capital have actually been people that have been friends of friends, mutual friends,
Yeah.
people kind of in that ecosystem and network, which is super, super cool.
Yeah.
Similarly, looking at your investments like that, there's always going to be another deal. There's always going to be more deals. This is never going to be the last one, right? If it is the last
Yeah.
one, you probably don't want to work with that person anyways.
Yeah.
But just go slow in these partnerships because these are basically marriages for a certain extent. And
Hmm.
ideally, we get partners like yourself and other people that, once you kind of bring your capital to our deals, we do well. And, we can't control market forces, but we can't control how we communicate our effort and how we handle stuff and how, we are reactionary if something kind of bad happens and,
Yeah.
anticipating what's next. So I think it's a really good tip there that people kind of you maybe seem to look past, but just going slow. I think we all get excited about a new idea,
Yeah.
kind of being around the self-help kind of journey there, if you will, of kind of doing syndication and whatnot, because everyone's kind of in that betterment journey together. It's
Yeah.
awesome, but go slow and kind of ease into these processes.
Definitely. And it's always like, it's that perpetual learning. I think that separates a lot of people. Is this person learning and educating and pushing the bounds and talking about the market? Or are they kind of towards the end of their career? Like they don't really care. They don't need to do these things. Like they're just buying, because their team tells them it's a good buy. Like I just like to see those things and see how they react and see how they operate. And then ultimately, there's a little bit of a gut filter too, where I may just not like the way you say things, or maybe it doesn't make sense to me in my head. Usually there's kind of a subconscious thing there that tells you there's a contradiction here, and maybe you don't notice it actively, but listen to that gut filter too. They should steer you pretty well.
Yeah, without a doubt. And, at the end of the day, we are hardwired for basically finding issues, when we're
Yeah.
heading to, avoid, cold winters, human perspective, avoiding big animals that will kill us.
Yeah.
Similarly, these little antennas, these little feelings that we get, that gut reaction is a super important thing. And,
Mhm.
it would be a shame to ignore your gut, go into something and have it not work out because you knew in the back of your head that, in
Yeah.
fact, there was some downside there, of course.
Yep.
So that said, let's talk about, obviously, you mentioned what you think will do well. It's industrial, it's mobile homes, it's multifamily.
RV. Yeah.
Yeah. What do you think will do well? Or sorry, what do you think will do poorly here coming up? Like, what is something you wouldn't touch that they think you find to be radioactive, or something that you just wouldn't want to do, even if it does have a comeback?
Man, I think I imagine what you hear a lot when you ask that is people will say office.
Mm-hmm.
I'm actually not, allergic to the office space right now. If you look at the reason why people don't like office, it's because it makes up a majority of the distressed debt, whatever the $2 trillion debt wall coming due in the next couple of years. But if you really dive into the metrics of it, those are massive offices, like big San Francisco downtown headquarters that are making up a big lion's share of that debt. So, if you're kind of in that small or medium sized office space, I think you're still doing fine. One thing that I don't personally like is I don't like a lot of single tenant stuff. So if I am evaluating something like an industrial opportunity, I'm more looking for a fund. Typically, single tenant leases, they're good when they're good because they're long leases. They got baked in rate increases, but they're kind of tough when they're bad. It takes a long time to fill those spaces. You can be vacant for a long time. So to me, I don't love single tenant. I like the diversity of income. Or if I am looking at single tenant assets, I want to be part of a fund. So that's something that, it would keep me up at night, because I would just be thinking the whole time, what if this tenant leaves? Because you can break your contract, you can break your lease, you can go bankrupt. Like, they're not just a surefire 20-year lease, right? Those things can happen. So to me, I don't like those single tenant type things. Those kind of keep me up at night. Like I said, there's nothing wrong with them. There's people that crush it in the single tenant triple let lease space. It's something that the return on a headache isn't what I want.
Yeah, it's not the appetite that you're looking
Mm-hmm.
for, so that makes sense. You've been such a great guest. Thank you so much. Last question I have for you here. Do you have any kind of contrarian or hot take that may be personal to you that other people might not have per se?
Man, I felt this way for a while now, but I think I more recently have heard people start to agree with it. And my little context to this is, there's always a little bit of headbutting between like the alternative investment space, fund managers like me in the private equity real estate space, and let's say like the financial advisory space,
Mm-hmm.
right? I have my opinions on why that is, but that's neither here nor there. But I feel like with the accessibility of investments and information nowadays, that traditional financial advisor role is like useless. To me, I don't think I would ever pay somebody to invest in a couple of index funds, because historically speaking and statistically speaking, they don't outperform an index fund anyways over the long term. But what I do see being very successful is, instead of having this financial advisor who just kind of, like I said, trades index funds for you and they take a point of everything you got, is this more like virtual family office, or this virtual kind of thing where everything is in house, where they have a tax strategist, they have an insurance strategist, they have a legal team, they have all these things to give you a really good financial plan, instead of it just being a guy who sits there and kind of buys index funds and just kind of holds and waits for you. So I think that's kind of my hot take that I've kind of expressed. And to
Yeah.
me, I've heard that be more common. And people say, yeah, that kind of makes sense, because you can buy these index funds by yourself nowadays. It's not hard. So to me, I think the value that industry offers needs to step its game up. And it looks like it's going that way. But I think, that traditional, I pay my advisor 1%, they give me index fund returns, that just won't cut it anymore.
Yeah, I think the world is changing on that front as well, in the sense that I think that middle tier level of kind of call it, financial advising is going to go away. It's
Yeah.
going to be people who are ultra high net worth who need to have
Yeah.
like a larger plan together. I'm talking
Mhm.
about probably $15 million plus. And that middle size, call it 2 to 5 million per se, if you will, which
Yeah.
is obviously someone who's successful.
Mhm.
They're going to be kind of start doing stuff themselves. And I think millennials and Gen Z will be the case study of that, where they're going to think to themselves, yeah, I'd rather be in control of my money. I don't see the value in paying someone versus someone historically has not been that way. So I actually think
Yeah.
you're pretty spot on there. I think it's something that will only continue to grow.
Mhm.
And it's kind of funny. I remember when I was selling houses, anytime I heard someone say, I'm going to run this by my financial advisor, it was automatically going to be a no. And I understand that's just how the game works, but it was
Yeah.
almost like a joke to myself, like, okay, well, it was nice knowing that client because
Yeah.
they're never going to buy this property, despite
Yep.
how good, the fundamentals were, the interest rate they
Mhm.
were going to get was going to be.
Yeah.
That's just how it worked. And, lo and behold, that's been the case. And nevertheless, so kind of funny that you mentioned that. And I don't necessarily disagree at all with that take. And I think that is just kind of the general trend with a lot of people of, hey, they got $50,000. They're not going to call their, Schwab account person.
Yeah.
They're going to put it into maybe crypto. They're going to put it into the S&P 500, or they're going to call you and say, hey, what's the debt fund that I should be looking at? So
Yeah.
with that said, Justin, thank you so much for your time today. Where can people find you and reach out if they want to learn more about you and your investment club?
Yeah, I mean, I'm very, very active on LinkedIn. You could find me there. The website is presenceclubinvestors.com. So, I work with investors all the time, looking to place capital in different deals. And I spend a lot of my day meeting people like that, looking at deals and meeting awesome guys like Craig. Yeah, just connect with me. LinkedIn, I'm on there every single day. You can't miss me.
Excellent. Justin, thank you so much for your time today. Looking forward to seeing you hopefully soon in person. I don't think I'll be catching you at any of the conferences in the first half of this year, but hopefully we can link up at some point, do deals together, share notes, and would love to have you back on the show.
Awesome. Thanks, Craig. This was awesome, man.
Yeah, thank you. Take care.